right, so good afternoon, everyone, and welcome to the last webinar of Matchathon 2020. So Matchathon 2020 is an initiative by Innopark Ventures in collaboration with Niti Aayog, that's Atal Innovation Mission, and Atal Incubation Center, part of the IIIT Hyderabad Foundation. So as a part of, the Matchathon August, so today we have an excellent speaker and an accidental entrepreneur. That's how she calls herself. So we have today Cathy Guo, who is an accidental entrepreneur and a technologist. She is on the founding team of First Principle, which is an early stage fund that leads market research and due diligence, and has also co-led investments in portfolio companies such as Clinic, Healthcare, and Third Wave. She also works with Nikhil and Nitin Kamath, the founders of Zerodha, and setting up True Beacon, which is a new age asset management company. And we had Nikhil join us a week ago. So previously, Cathy was the CEO and co-founder of Dunya Labs, a blockchain tooling company that's headquartered in Singapore. And she also built a 20-member technology team in Bangalore, and she has stayed in India ever since. So Cathy has a degree in economics and philosophy from Columbia University, and she has co-authored Myth of the Entrepreneur. It's actually a book on social entrepreneurship published by HarperCollins India in 2017. So here we have today to understand, what it takes to get the first check. So Cathy here will be sharing lessons from starting up and venture investing. Welcome, Cathy, and thank you so much for being with us here today. And it is over to you.
Absolutely. Thank you so much, Joanna, and thank you to the entire Innopark team. I've known you guys personally and now professionally for some time now, and I think what you guys are doing is really awesome for the broader ecosystem, as well as a new entrant in the venture ecosystem. So that's really exciting. Great. So I think we can get started. So I've just made a couple of slides so you guys don't get totally bored while I'm speaking. I think Joanna covered the personal intro pretty well. I just put a conglomeration of images here to give you guys some more color. I've definitely had a little bit of an untraditional career path, maybe made some atypical choices, and I hope to also explain maybe why and some of the rationale behind that. So I'm Chinese American by background. I'm born Chinese, spent my first 10 years there, and then emigrated to America with my family as a first generation immigrant. I was lucky enough to get a fantastic education at Columbia and 1 year at Oxford. And I kind of had some serendipitous interactions throughout my university. So I met this promoter of a large Indian renewable energy firm when I was still in college. That's where Myth of the Entrepreneur and that whole project was born, writing about social entrepreneurship in India. And that was actually the first time my exposure to India as well. And spending time, during that project with established entrepreneurs, I think showed me where I was typically more of a risk-averse, professional-oriented person, that there's so much creativity and excitement in creating something from scratch, that it really changed my mindset about what different paths I could take, given the fact that I've been very privileged to have a great education. And so, got bitten by the entrepreneurship bug. I tried to do my first startup pretty soon, right after college, with a batchmate of mine from Columbia. It was called Dunya Labs. Because I was coming to India quite often, I had this idea that we could, base a tech team out of Bangalore, while building essentially new age application tools for a global market. So our customers were primarily in the US and China, and we were essentially helping them with developer tools to build decentralized application in the blockchain ecosystem. I think that what was funny is that if, during Dunya, I used to always tell people, if you had asked me 2-3 years ago as a humanities and a philosophy student, as someone who had limited exposure to the tech and startup ecosystem, and also someone who maybe never even considered that path as a journey, if I would be actually predict I would be doing, Dunya Labs or doing something entrepreneurial, I would have definitely found it very strange and impossible. But I think that my journey also is some testament that adaptability and you can break out, whether it's someone from a non-technical background, whether it's a woman, whether it's someone who's quite young. I think that it takes, it's a little bit of an upward battle, but it's definitely still possible to create a network in a completely new country, to create the momentum you need to build a business. Ultimately, we decided to shut Dunya. I think that we were a little too early in the market and we didn't see application side adoption in the blockchain ecosystem. More of the asset side of the market was getting built out. So we took a call, returned quite a bit of capital to our investors, and since then I've been kind of just took a call to stay in India and develop myself professionally in India. And right now I essentially spend the majority of my time doing angel investing with my partner Nitin Sharma under a brand called First Principles. And through that, it's given me a great, I always tell people that in venture, one of the greatest things is that there's no other job in the world where my job is to listen to a bunch of people every day who are much smarter than me, tell me all their secrets. But that's kind of how it feels like to be a part of venture. I get to engage with a lot of interesting entrepreneurs, hear about their stories, what they're tackling. And, the objective today, I know that many of you guys are maybe first-time entrepreneurs or on an entrepreneurial journey already, or perhaps thinking about taking the plunge and hence exploring through Matchathon and this Innopark event. So I just wanted to give you guys some color as someone who's been on both sides of the table, right? I've been on the operator founder side of the table as a complete newcomer to that ecosystem. And now I'm also on the other side of the table, which is more on the venture front. And just to give you guys some color about how you think about fundraising and your first check from a founder perspective, as well as how you can think about fundraising and your first check from an investor perspective and what they look for. So we can just jump right into it. Just to give you guys some sense of what I've been doing in venture, and some of the numbers around just how much diligence goes into actually finally investing. At First Principles in the past 3 months, I myself have looked at, 355, I think now it's maybe closer to 375 deals. Out of that, maybe 5% or so, we've decided to take some calls. So we've done about 60 introductory or various stages of due diligence. And at the end of it, we only invested in 3 companies. So the funnel, if you think about it from a venture capital perspective, is you might get very, very interesting projects, but at the end of the day, it's still really just a 1%, 2% that you might decide to take a bet on. So I wanted to start out by actually asking the opposite question. I think many people come from the venture perspective and try to tell founders, what venture investors look for, et cetera. But I actually think a more fundamental question that doesn't get asked enough is, if I am a founder, am I actually ready for my first check? And what does equity and institutional capital mean for me? One thing I've learned a lot from my journey is not to pay too much attention to the external environment. Kunal Shah, I'm sure many of you guys know him. He's a great mentor to me and also a fellow philosophy student. And we often talk about how this fundraising worship in the startup ecosystem is quite strange and counterintuitive, right? Because if you think about it, and literally all of these news articles I just pulled today from the front pages, literally live today from various websites like VC Circle and TechCrunch and whatnot. But you can see that there is this culture in the startup ecosystem of celebrating fundraising and using fundraising as a proxy of success. And I think that one thing to keep in mind as founders is that doesn't necessarily make sense, right? If you think about it, fundraising just means one of 2 things. You are diluting your stake in your business as a founder, or secondly, you're burning cash and thus you need external capital. I think that neither of those things is by definition necessarily good, and it's certainly not necessarily a metric for success, right? So one of the first things I think is just to step back and focus, pun intended, on first principles about what is the actual reason for founders to raise equity funding and what that means for you as a business owner. And we should break this myth of just fundraising as a proxy for success, because I think that there's a lot of survivor bias in that as well. Most funded companies also don't create good outcomes for the founders or for the founding team. And I would just urge people who are coming, into the ecosystem now to be more open-minded about what venture capital and equity funding is versus even other avenues of capital. So we can go to the next slide. Yeah, so I think that these are the 3 points that I made. Equity, the first thing just to know as a founder is that equity is expensive. You're giving up essentially shares of your business for capital, and that is one of the most expensive ways to raise capital in the sense that if you look at debt or other types of capital instruments, you wouldn't be giving up a piece of the upside, right? You might be giving up some fixed interest rate or something like that. So equity is a very expensive mode of fundraising, and that's something that should be in the calculus of every founder. Secondly, equity is obviously dilutive, so you have to think about it as every time I'm taking in more money, I'm also limiting my own upside in my venture, right? And you guys as founders or aspiring founders are going to be putting your blood and sweat and tears and years into this, and that should not be something that's easily given up. It should be a very considered decision. And thirdly, I would just mention that not all equity is equal, right? When you are actually taking in money from an institutional investor, there's a very big difference between someone who can truly push some strategic levers for you versus someone who's more passive and not as involved in the business. And I just put these two logos down here, Club and Upeka, because I think that, in fact, these are companies, both companies that First Principles has funded, and both of them are essentially alternative funding mechanisms for startups. Club provides revenue-based growth financing for brands. So if you're growing as a brand and you want to add 4 or 5 locations or expand to different localities, they will be able to provide growth capital, which is linked to your revenue. And Upeka, which is actually kind of a value SaaS incubator where they go ahead and they have cohorts of SaaS founders who might not necessarily need venture funding ever because they're able to target niche markets in the US or globally, and be able to bootstrap themselves to profitability. So I think that, again, it's just that I want to put a context to this conversation rather than jump just right into how do you raise your first check. I think actually the process starts in, firstly, why am I as a founder looking for venture funding? And secondly, out of all the various ways of raising capital, why does venture equity funding make more sense to my business, especially as we're in a pretty mature environment now, whether it's globally or in India, where there are other avenues of capital that might be a better fit for your business. And these models should be, I think, more popularized and become more mainstream, especially as some of them are better fits depending on what kind of founder and what kind of business you're building. So next slide. Yeah, these are some bad reasons, in my opinion, to raise venture capital. The first is that because it validates my business. I think this is a common myth, which is that if I have an external investor, that means my business is good. I think we'll cover this in a later slide, but the economics of venture capital are such that there are many good businesses which are just not fit for a venture category. Doesn't mean that your business is not good. It just means that there are very specific parameters for what makes sense for venture funding as a category. The second is, to make money. I think that very obviously a lot of the paper valuations we see and a lot of this kind of financing, fundraising hype we see in the media, none of that necessarily translates into liquidity. None of that translates into direct wealth of the founders, right? In many cases, if you just look at what's happening in the ecosystem, Urban Ladder, for instance, an extremely great brand, one of the first successful D2C brands in India, been around for 7 to 8 years, raised over probably $100 million. They're just recently, I think, getting sold for a similar sum. And the way that venture funding works is that your investors will always have preferential terms to you, right? So in the case of an exit, the founder's exit and liquidity is kind of at the bottom, and the investor's liquidity due to liquidation preferences, is the technical term, will always be higher. So this is a case where a company is, from a business perspective, quite successful, but will essentially create an outcome only for its investors, in the case of Urban Ladder, and not even for its founders. So I don't think that you can equate having more venture funding as you will make money. In fact, when you go to the end of the road of like either selling your company or going public, that's really the only time when you'll be able to see if the path you've taken is ends up being wealth accrued to the founders. And the third thing is just that having an investor will help. I think there should be investors. We talk a lot about co-founders and how you pick co-founders and the amount of thinking and time and how it's like a marriage. But I really think that investor is just as much a marriage, especially in your first check in your early stage, that is as committed of a relationship as a co-founder, in my opinion. And that's because that person will be on your cap table, they will be your early champion, they will be, the first check is really that key investor who needs to make a pretty big difference to your company, and should be someone who is willing and open to making a big difference to your company. So I think that having an investor does help, but the question is, I think the level of discerning founders don't take enough time to think about, is this really that 10x investor who's going to be my champion, who's going to open doors for me? Because at the end of the day, every single investor has a portfolio. And if you're not the priority in the portfolio, then you won't be getting face time or the strategic benefits that you should be. Next slide. These, I think, are the good reasons to fundraise or raise venture capital. The first being, as a founder, you have to feel extreme conviction and dedication to your company. I think that I only mention this point because bringing in institutional capital on board clears a certain level of commitment, right? Now you only not have a fiscal responsibility to yourself and your employees, but you also have a very real fiscal responsibility to an external capital partner, and that should be taken very, very seriously. So you have to be ready for that kind of commitment. The second, and I think most important thing is, will equity capital actually help your business achieve non-linear growth? Like I said, there are other avenues of raising capital as well, whether it's through debt or revenue-based financing or other types of bootstrapping mechanisms. But in many cases, if you look at the history of venture capital, it was for businesses where if you put in some more money today, it can go 10x, right? If you put in kind of 2x the money that the company has, it can grow 10x or 50x. And that non-linear growth and using capital to achieve that non-linear growth is probably the biggest kind of indication that you are fit and should be looking for something like venture capital. And thirdly is having an investor in mind who can add significant strategic value. This can be in multiple ways. The first is obviously in customer relationships and evangelism. For many startups, your first check investor will be the person who convinces their ecosystem to be your first customers. I've seen cross-border startups where it's been very helpful to have a first check investor. As someone with local market knowledge, maybe you're a SaaS player or a brand that's trying to sell cross-border, maybe you're trying to do a US India play, maybe you're like me, other direction. So I think that local market knowledge and navigating an ecosystem that you might not be a part of is also another great reason to have a strategic first check investor. The third is if you have an investor who's a domain specialist with some specific playbooks. There are fewer examples of this in India, but you think about someone like in India, which is focusing on deep tech, like speed in their portfolio enterprise SaaS. If you look at Fireside Ventures for D2C brands, there are investors who have created niches and focuses in their portfolio. And that's just the benefits of compounding, right? They're able to, throughout their portfolio, because they see so many similar types of these companies, they're able to transfer a lot of value in terms of playbooks, in terms of operational, in terms of growth, even recruitment. So I think that for some companies as well, having a domain specialist first investor makes a big difference. And obviously, all investors, I think, should be champions to your future fundraise. Even us at First Principles are really involved in our startups and how they get to the next round, if they're hitting their targets, how to be better storytellers. And that's, the bare level minimum that I think your first check investor should do for you, but hopefully even more so, even tactically in how you're running your business is also somewhere where they should get involved, especially if we're talking about a first check kind of investment. Next slide. So that kind of gives you some color, at least in my view, of what's important from a founder perspective. Just to recap, number one, is my business the right business for venture equity capital? Secondly, do I have a good reason to fundraise right? And those are two very important first principle questions to answer. But let's say you answer both of those and you say, yes, I'm a tech company, I'm going to benefit from equity capital. I'm someone who can grow a lot if I just have money in the bank right now. I'll have exponential nonlinear growth if I'm able to turbocharge my distribution or sales. And I also have someone in mind who can really up the levers in terms of my business. So then we can get into the other part of the discussion, which is how are institutional fundraisers or VCs really evaluating at the first check stage. And this is, again, just the caveat, very much in early stage. I think at various stages, whether it's seed, pre-series A, series, also new stages created all the time. I see series A plus now, series A minus, pre-seed, post-seed. But I'm just saying this is more really for, let's say, first check to pre-series A. I would say that the rest of the discussion is really focused on, in that particular stage, what are investors really looking for? So we can get into it. I think the first context that I wanted to set here is just a little bit of overview on VC economics. So I think the key thing to understand is that if you're looking from the other side of the table, like I'm a venture capitalist, I'm an investor, is that I might have a portfolio with 100 different companies. And out of that 100 companies, the reality of venture capital is it's a high risk, high reward kind of investing asset class, right? So my typical math around my portfolio is that about 5 of those 100 companies I invest in is going to make all of the returns for me. They will essentially be returning 3x. They will be returning my LP money. They will also be returning all of the alpha or the upside or the carry, right? And the rest of it, like 45%, will kind of be these middling companies where they haven't shut down, they haven't been acqui-hired, they haven't died, but they also haven't really grown, right? Over a 7-year period, they've only grown 2x, 3x maybe, and they're kind of stuck there. So that's the reality for like over 45% of the portfolio. And then 50% of the portfolio, 50 companies out of 100 will just die. They will be sold off, they will shut down, and there might be some capital recovery, they might not. But the key thing to understand here is that a venture portfolio is always one of massive asymmetric return. You're not trying to optimize for 50 companies doing well, doing 5x instead of 3x. You're only trying to optimize for those 5 companies to make sure that they're 50x, 100x, 1000x, whatever it is. So in that sense, you have to take that calculus and put it into the mentality of a VC and realize that if I'm only as a VC trying to optimize for those 5 bets, my key question whenever I approach or invest in a company is, how is this going to be a huge outcome, right? I'm not looking at companies where it might be the 1 to 2x or the less than 1x. I'm just thinking, is there a high probability, at least from the information I see today as an investor, that this has the potential to become a huge outcome? Because in my portfolio, only those 5 or 6 huge outcomes matter, and everything else is kind of a wash anyways. So there are 2 kind of ways of looking at that. 2 questions and cardinal questions that I ask myself about every single team and every company I meet is, number 1, from a top-down perspective, how does this become a billion-dollar business? And that's a lot about picking your market, right? How big is the spend in this current market? How quick is that spend growing? Who are the players that are already taking on some market share, et cetera? It's a top-down exercise of making sure that the space that the founder is playing in is large enough for a billion-dollar outcome. So for instance, if you're doing something extremely niche for, I don't know what example right now off the top of my head, but if that market is constrained and there's only $30 million, $40 million every year, that's the total addressable universe of what can be made, that company will never be part of that 5% or 5 companies that the VC is looking at that will return the majority of their fund, right? So I think that top down, how big is the market is a very big question. And I'm sure you guys have heard that plenty of times. And the second is kind of the bottom up analysis. So wherever the project is, whatever the business model is, how many users, how many paying users, how much top of the funnel, how many people do they need to get to $100 million ARR? And both these questions, if you think about it, are again optimizing for that huge outcome. They're not optimizing for a profitable business. They're not optimizing for a medium but very healthy outcome, like a company that makes maybe 300 crore top line every year. That's a fantastic business, but that's not, let's say, a VC business, right? In the sense that it's not going to achieve the multiples that are required for the economics of how a venture fund works. Yeah, we can go to the next one. So that's the number one, I think, key question. And to internalize really as a founder, the way that venture capitalists make that calculus will really help. But just to cover some other tangential points as well, very important points that we always look for in any kind of early stage team. Again, at an early stage, I think one of the key things that founders get caught up in is that they think that what matters is their product. They think that what matters is their business model. What matters is how customers are responding to the product today. But the reality is that at an early stage, in almost 99% of cases, what the company looks like at the finishing line will be very different from what the company looks like at the starting line, right? We've heard so many examples of this. Instagram was a pivot. So Airbnb was a pivot. So many of these companies in their first, second, and third even iterations were not what they originally set out to be. So I think venture capitalists, it's like we've seen this movie before, right? So we're not caught up so much in the details of exactly what are you doing today and exactly what is the business today, because we understand that at such an early stage, as you go through the 10-year journey of scaling a startup, that there's going to be plenty of iteration. So if you can't fix what the business is today, then what can we evaluate as investors? I think one is, I've already covered it in the previous slide, is the size of the canvas. You want to make sure that whatever space or industry the founder is playing in, that there's enough money to be made and there's enough of a sizable market so that even if there are slight deviations to the original product or positioning or plan, that there's room essentially for that iteration and that the market's big enough to actually handle various forms of experimentation. I think the second one, which is probably the most important thing, is who are the surfers riding this wave, right? If we've established that it's a large market and we've established that there's also good tailwinds for that market, then who are the surfers? And this is something that we internally call founder market fit. So you want to be sure that this is a founding team which is capable, number one, of generating unique insights. I think that's extremely key, whether it's unique insights about a specific customer base, unique insights about an industry, and secondly, that these founders can iterate and turn those insights quickly enough into a revenue generating business. So I think that when you are speaking to someone, like if I'm speaking to a founder, I really want, it's less about what their business is today and it's more about their thought process. How are they going about listening to their customer? How are they going about, looking for a problem space and what motivates them about a certain problem space? How are they thinking about challenges or evidences that their current solution is actually not the best? So I think the key thing here is making sure that the founders' background, articulation, as well as thought process is a good fit for whatever market they're in, and that the founder has a good way, or the founding team has a good way to iterate quickly, because in startups, you realize everything will change. Your assumptions will constantly be challenged by the market, by your customers, and whether or not that adaptability and innovative adaptability is really in the DNA of the team. And for different industries, I think there's also the question of, in founder market fit, do I need to have prior experience in an industry? Will I have leverage, or will I have some credibility in an industry, and will that help? I think that really varies, honestly, across industries. So there are definitely industries where we as investors will put a premium on previous specialization. For instance, something like dev tooling, I guess it's a little funny because I am a generalist founder who ended up doing a dev tooling company, but generally I had a very, very technical co-founder with all of that background. So I think that's kind of what plugged the gap. But one important thing, in highly technical fields like deep tech or vertical SaaS, or if you're doing logistics, something ops heavy, then definitely that operating experience and previous specialization will have a premium. Education is also a space where at least our team at First Principle believes that founders with a strong background in education and pedagogy matters. It's not something that people can just come in as generalists and kind of get the same results. So whatever industry, some industries we do put a slight premium on specialization, but there are also many industries where I think generalists can thrive. And it's more about how the founders and how the entrepreneurs, again, are generating insights and iterating on those insights. So social networks, to give you an example, or direct to consumer brands. These are not things where necessarily we would put a super high premium or requirement on previous operating experience, previous specialization, but it's somewhere where the thought process, again, and the DNA of the founding team really matters. So the key thing, again, is takeaway here for point number 2 is that at a very early stage, the exact business now matters less than your engine as a founder for insight generation and for iterative kind of innovation. I think that's one key takeaway that I think I'll try to give to you guys. And the other part of being the right surfers for the wave is really also about character. I think one thing that's not spoken about as much is that the founding journey and the entrepreneurial journey is extremely hard, and it's not glamorous. It's very tiring. It's very scary. So one of the things we also try to gauge in early stage is what's going to happen when the going gets tough with this team? What happens when all their assumptions are going to be challenged? What happens when they're going to be running out of money? What happens if there's going to be some adverse things happening to them from a regulatory or team front? Are these people who will pull up their bootstraps and actually embrace these challenges and survive and even thrive through them? There's always that story about, the Airbnb founders maxing out, all 4 of them maxing out like 5 or 6 credit cards. They had a full binder of credit cards that they had maxed out because they weren't able to get any VC funding. So are these founders people like that who believe so much in this very, very long journey that even when others lose conviction, because the markets will change, right? And at the end of the day, I always say that conviction from investors means a lot less than convictions from the entrepreneur themselves. Investors, we are people where we're looking at multiple industries, we're digesting reports, we're speaking to people, but we will never be the first ones to actually know what is happening on the ground, right? That conviction has to come from the entrepreneurs, that tenacity has to come from the entrepreneurs. And so that's also a key kind of right surfer riding the wave parameter that we look for in early stage teams. And the third thing with the right surfers things as well is I think we do look for execution. In an early stage, it's a little bit tricky because on one hand, you don't have a lot of evidence for execution, right? Some teams might not even have a product. And even if they have a product, it's an alpha, it's a beta. They might only have their first 10,000, 20,000 users, maybe 5,000, maybe in some cases just a couple hundred. So you don't fully see, you aren't able to always see what the execution capability is. But again, I think that that's why in an early stage, every single interaction you have with an investor is a proxy for them gauging your execution ability, right? Every simple things, even like how you write an email, how you're sending your investor updates, how your deck is presented, even though these might seem like tangential or more cosmetic items, I think that at an early stage, they also become a proxy for execution. How much time and effort is anything that's being put in front of me from this team? How does it look? How is it being presented? How are they, telling their story? So I think also at an early stage, in the absence of a lot of metrics and in the absence of being able to prove that there's product market fit for whatever you're building, I would be very, very careful to ensure that even the smallest communications and the smallest collateral that you put in front of investor is your best foot forward, right? Because there's so little data points and everything else will also start to become a proxy for how does this team deliver? How does this team respond to questions? How does this team present content? And so I think that's something that's also really important. And the third thing that I was going to stress, sorry, we'll just go back. The third thing that I was going to stress is this thing about storytelling. I work with a lot of founders in my portfolio right now at First Principles, and we spend a lot of time on storytelling. I think that the key thing about storytelling is that it's different. It's a different skill than building a good business. There are people who are very good at building businesses and are very bad at storytelling. There are also people who are extremely good at storytelling and not great at executing on a business. And I'm sure we all know examples of various kinds of characters. But the reason why storytelling is something that's important to investors is that it becomes a proxy for general salesmanship, because you realize that in an early stage environment, when you're just starting a business, almost everything you do will be convincing people to take a leap of faith on you. This might be an early team member. This might be a hire you want to do. This might be your first large corporate customer. This might be an investor. And so it's like we understand that the only companies that are going to survive when they're going from 0 to 1 or even 1 to 10 requires a team where at least 1 or 2 people in the founding team have a strong DNA for storytelling. Because like I said, at an early stage, you don't have evidence, you don't have scale, you don't have the benefits of having lots of numbers to convince someone based on history and fact that your product is a good one. You will essentially constantly, whether it's in terms of capital, your own talent, or your customers, you're constantly going to be asking many stakeholders to take a leap of faith on you. And it's not just, I just want to make this point, because being a good storyteller is not just about investors wanting to make sure you can pitch to other investors. It's making sure that in the DNA of the team, you can survive this early stage hump of having to rely on this kind of faith-based storytelling to convert some of your early customers and key accounts. So I think that practicing being a good storyteller, where you can be concise but also clear, where you can communicate your unique insights in an articulate way, and where you can also demonstrate self-awareness, right? One of the questions we always ask founders when we're evaluating them is, what are your weaknesses and what are your team's weaknesses? Because that visibility is also something that is quite dangerous, and we prefer a thoughtful, mature, and perhaps more self-aware founder than someone that is unable to also see the gaps in their existing team or business. So these 3 things, especially in a very early stage where there aren't metrics or numbers to really back the decision of whether or not to invest in a business, I would say these are the top 3 things that we look for as first principles and also as just venture capitalists. Okay, so this is the this is kind of the final point I was going to make, which is, I've been on the founder journey just for 2 years and early in life, but I think it was still a really great learning experience. And one of the things I definitely experienced is that being a founder is super lonely. It always seems like there's not people who are going to tangibly help you. You're always looking to, try to firefight or try to make something happen out of nothing. And that's kind of an alienating journey, especially because you might not be able to communicate to your parents, or I had a difficult time communicating to my family what I was doing. I had a difficult time communicating with my friends who maybe were not exposed to the entrepreneurial ecosystem. So I think it's very important for early stage founders to prioritize creating a network for themselves and prioritize creating that kind of support system. So next slide. And as someone who is new to India and obviously an outsider, I think that whatever little I've done in this country so far has basically been based around these 2 principles, and it has gotten me, I think, in a good place, and I feel much more comfortable in making a decision like relocating to a completely new society by nature of following some of these principles. So I hope they help you as well. The first thing is the power of compounding. I think as I've grown, it's one of the most important truths in business that I keep learning again and again, whether it's compounding knowledge, compounding networks, compounding money, compounding people. And the power of that is just absolutely unfathomable, right? If you take $1,000 today and you compound it annually at 30% for 20 years, it becomes $375,000 at the end of those 20 years. But 90% of those returns are actually in the final 5 years. So one of the things I tell people is people always talk about compounding, but they don't talk about how compounding is always on the long tail. It's not the first 90% of the time where you're just putting time into a relationship or time into learning something or time in an industry. The first 10, 15 years might show little results, but the last 5 years of that 20-year journey will show huge results. And so I think compounding is something in principle that we all understand, but it's something which requires immense patience and a very different view on how you approach, whether it's relationships, businesses, money, etc. And when I look at compounding and this, general goal of creating a founder network, I think again it's about that patience, right? Someone that might not be directly useful to you or your business today, um, maybe not today, maybe not on day 30, maybe not even on day 100, but maybe on day 200 they will become a customer, they will become an angel investor, they could become a founding team member, and it might even be much later down the line. But I think that one thing that's really helped me is essentially focusing on relationships and not focusing on transactions. And the only way to focus on relationships is to have only a few, right? I'm sure that all of you guys have friends or personal relationships, and it's impossible to have real relationships with like 50 or 100 people. At least maybe I'm a little bit of an introvert as well. I found that, I do best when I keep my close circles to maybe 5 or less, in various spheres, professional, family, personal, whatnot. But I think relationships are something that is much more selective. It's not tactical. It's about finding people where you can align in values, where you can align, in mindset, and just putting a lot of effort and energy into growing together, hoping that one day, your paths will align and something tangible might happen for your business or whatever is outside of it. I only mention this point because I've met a lot of people around the world, and I think in India especially, I've met quite a few people who have this like power connector role where they spend a lot of time enabling transactions. They know a lot of people and they're socially connected, and then they try to put this person with that person and make something happen. And what I've seen is that it's not an effective way of actually creating value for yourself, because that's a very light touch transactional way of approaching relationships. And even if you get lucky once or twice, I don't think that it's actually something that brings in those really big changes, right? To give you guys an example, like I met Nitin, who's one of the co-founders of Zerodha, on a complete whim. One of my friends had introduced me to him and said he's invests in fintech companies. Why don't you talk to him about Dunya? We had one conversation, and then I don't think that it was a good fit, so we never really communicated about Dunya again. But I would always send him things that I thought would be of interest to him, whether it's something that I saw in the fintech space, something that I saw that was an innovation in stockbroking in the US, something interesting about capital markets news. We would have conversations about the markets and other type of things, but it wasn't something that was, I had nothing to do with him, and I didn't want anything from him, really. He was just someone who was a good guy, and I felt like, philosophically as well as from an entrepreneurial journey perspective, he had really great perspective on the local ecosystem. But after I shut Dunya, I went and also took time to speak to all the people that I had connected with, like Nicole and also like some other people, and just very frankly asked them for advice, right? I was like, I did my first startup, I'm shutting it now. I'm not sure about whether or not to stay in India. What should I do? And the main thing was I was just asking for any general advice. And out of complete serendipity, Nicole at that time was starting up a new brand in the Zerodha ecosystem, Truby, and led to another, and serendipitously I helped him for about 8 to 10 months building that from 0 to 1 level, and we got the opportunity to work together to create something together. I got the opportunity, which was amazing, to see the insides of Zerodha, which is one of the greatest tech companies in India. Similar in terms of my current role at First Principles, Nitin, who's the partner there, was someone who also, we just shared a lot of learnings. We were both investing and engaged in blockchain, and we were constantly, sharing with each other, knowledge sharing, etc. And now we're building an entire concept of angel investing venture studio together, and it's super exciting. But I would not be able to have that relationship with 20 people. At the end of the day, I just invested in, honestly, since I've come to India, maybe 4 or 5 people, kept it very substantive, kept it very long term. And some tactical things have emerged from that, which I'm very thankful for. But even if they didn't, I think that on the whole, it would have been additive to my journey. So I would just urge you guys, to number one, think about hustling, or think about starting up, and even how you build your networks from a relationship perspective versus a transaction perspective. And also have patience, because in many cases, things will only bear fruit at the end of a very long period. So that's all I had to share for today. I know it's a lot of random information, but hope it was helpful for some of you guys and happy to take questions.
Sorry, I was just going to first, if there are any questions, you could start reading them, but I was just going to say thank you so much, Cathy, for sparing time for spending. I realize that wasn't. Thanks so much for taking time out of your schedule and spending this with us. I think we made the right choice by saying we won't do a fireside chat because Cathy would have so many interesting things to share. Let her just focus and then share all her knowledge and experience about being in India and building all these cool things while in India, right? So thanks so much for that. And we'll proceed to Q&A now. Jo?
All right, so we have a question from Mihika. She says, how do you determine whether a prospective investor is actually a good investor? And where do you look for investors if you're not aware of one?
Yeah, that's a great question. I think I'll answer in the reverse way. So the first thing is, if you don't know investor, where to look. I think nowadays there's internet and stuff. There's literally databases where you can see there. I think there's over now like 250 or so active VCs in India. And many of them are very public about their information, right? Their philosophy. Most of them will post the information of their partners. Most of them will post their portfolio companies. And I think sifting through whatever publicly available information is one of the most important things. I know that many people say, you need a warm intro to get into to get venture funding. You need a warm intro. You need a connection. And that is the truth. But honestly, I have survived my entire life on cold emails. Like many of the people that took a bet on Dunya were people where I had no foot in the door. I just tried to make myself, to make them aware of what I was doing, show up at the places where they were showing up and just hustling from scratch, right? I think that, of course, a warm intro helps. No doubt about it. That's definitely a way to at least accelerate, your deck to some partner or non-analyst kind of desk, but it's not a requirement. I would not be scared of cold outreach, and I would leverage whatever publicly available information there is. Like at First Principles, one of the things we pride ourselves on is we look and respond to every single deal, because we think that even if you're just, a cold email, every single entrepreneur is putting their heart and soul into what they're doing, and they deserve a response, right? At the very least. So, and a rationale behind why or why not we're looking at something. So don't be afraid of cold emailing. I think, definitely look at whatever is publicly available. The second question, which is a little more hard, is is that investor good for you? I think at a very early stage, it's about having conversations with them, just like how investors interview founders extensively and with a lot of diligence. I think founders should turn the tables around and also do that with investors, right? There are too few conversations where even I've invested where I didn't think the founder really asked much about what our philosophy is, how we're going to help, what we're going to do for them, right? But I would just say that number one, be upfront and have those conversations. And secondly, if you get to a more serious stage, definitely checking with other portfolio companies, right? So what are other portfolio companies saying about this investor? Because just like how they do rough checks on founders, you can do rough checks on investors. You can just go to their website, see what their portfolio is, reach out to those founders, ask them, what is your experience like? I would say that for big venture capital firms, one thing to note, we're a smaller, boutique right now, but for large firms, it also has to do with the partner that's on your deal, because they might have 10, 20, 15, 8 kind of partners. And the experience will really vary as well, which portfolio you're under, because they're not going to have all 8 partners pay attention to your company. They'll put 1 or 2. So then it's also about who that specific partner is and how they work with startups, not just the, let's say, fund in general. So at a larger firm, I would also be careful about specifically checking, who that partner is, who that partner's team is, and, ref check what their relationship is like with their portfolio companies.
Great. That was quite insightful there, Cathy. Great. Now here's another question. What are the sectors that VCs are currently looking at investing in? So do you think is it seasonal? Is it a trend? Or do you think there's always a preference? Yes, you did talk about, certain investors looking for investing, let's say, in deep tech. Some of them invest only in fintech. So
Yeah.
how do you arrive at that probably? What are the sectors? And currently, what is it that, people are looking at?
Yeah.
Some of the questions here.
Yeah, so it's funny. Even when Nitin was brainstorming, I love the name First Principles, and one of the things we were joking about is like if you look at the history of venture investing, the very early stage, like when the Silicon Valley firms were coming up in the 80s and 90s, those were people investing at the edge of innovation. Nobody had any idea what the internet would look like. Nobody had any idea if people could do business on this new technology. And they took a huge bet from first principles, right? But what's happened as the venture ecosystem has gone so big is I think we've strayed a little bit from that as venture capitalists. There is definitely herd mentality. There is definitely, hot sectors where for 6 months, you're seeing this right now with EdTech, right? Every single venture capital firm is like, let me get an EdTech company in my portfolio because they've seen that there's one success, White Hat Junior or Byju's growing continually. And they see one, let's say, macro change, which is COVID. Now people want to, are more open to online education. And then everyone will rush to find the best teams and put money behind it, right? And these bubbles do happen. And for a while in India, I was talking to my partner Nitin. He has over 15 years experience in venture and over, I think, definitely 6-7 years at least in India. So there were other bubbles as well, social commerce bubble, vernacular content bubble, where you'll just see one thing become kind of trendy and many VCs will want to take a bet. So, but my thing is that, look, that should not matter to an entrepreneur, right? If you are starting a business because there's a funding bubble around that, I would urge you to reconsider starting that business because starting a business is such a large commitment and that bubble will end. And if you're not able to sustain your own conviction in an industry, in a situation where nobody believes it's hot, the simple example is EdTech. A lot of, like I just saw last week, Eruditus raised like $93 million or something. And everyone was saying, wow, they raised so much money. They're a 10-year-old company. And for 8 of those 10 years, EdTech was not hot. And they had to just quietly build their business ground up slowly, this, that, and not take advantage of any bubble. Now that they've grown and now they can take advantage of a bubble, right? And they'll be able to get some more capital. But my key thing is that, yes, there are trends in VC, there are hot areas, but I do not think that that should be at all something that founders really internalize or use as part of their calculus as to what they should start. I think that what's important is that if you already have conviction in an idea, the one thing I would mention is take advantage of bubbles, right? If you already have spent 5 years in EdTech and you love education and you always were going to do that, take advantage of this bubble because also bubbles are cyclical. It might be another 5 years before we see another EdTech bubble for some other reason. So it's more about never borrowing conviction from what the market is doing, but tactically taking advantage of the market based on what your conviction is. Yeah.
Great. I think that's very well put. Depends on the bubble, on what is doing well right now. Great. So what are the factors that investors consider while they evaluate a business plan before they invest in? So in your experience, what is it that you look into, when you're evaluating a business plan?
Looking at unit economics, looking at your channels, looking at your margin and contribution margin, all those. That's number one. Is this market big enough? Can a big business be created good? That means, are they good for their market? Are they good for each other? Are they a good fit for the business? Some businesses are very sales heavy. Do they have a salesperson? Some businesses are marketing driven. Do they have a good, really good, consumer insight marketing person in their DNA? So every business has some things that are more important than others. It depends on the business. And it's just about making sure that whatever business the founders want to do, the important things for that business are also in the founding team storytelling. So I think I've covered those.
Great. So let me see. So we have Rajesh who says, thank you, Cathy, for the nice talk. And said it's a very informative session. So I think that has been good. And I think, yes, you have actually preemptively answered a lot of questions in our session today, Cathy. Most of the time, the things that people do want to know is, what is it that investors look at? What is it? So you also told us, what is it that we should not look at? So you gave us both sides to, think about. And I think that was quite interesting. So do we have any more questions? Sita, do you have anything else that you might want to add?
I think I've had the privilege of knowing Cathy for a little less than a year now. So with that, I mean, we've shared many phone calls and we keep having random chats. And so I've asked her a lot of questions and she shares a lot of information. I think just as an individual, she just is somebody who loves sharing information. And I think this was so apt, and for the audience will benefit so much from it because it's also going to be available for people to access on different social media platforms. Thank you so much, Cathy. And I think some things that stuck by me, softer things that people never talk about, like, um, not just about what is the product doing currently, but is the investing in human capital is such a huge thing, right? Like nobody talks about that, but we're investing in the team. And thanks for bringing that up, because rarely do you see the product that you invest in, being the exact same same thing that it has been since day one. So pivoting and knowing when to do that, and that only comes from a great team. So we always invest in good people when we know that you're capable and are efficient and passionate about what you're doing. That is one huge metric. So thank you for thinking about the softer aspects of VC funds, because often we have a bad reputation, right? Like, so when people look at investors, they say, "Oh my God, now they're going to be like sharks with us," and all they care about is numbers, and they're just going to look at reports, and that's how they're going to be evaluated. So that's not the only thing, and I'm glad there's a new breed of us. And much like First Principles and Innopark Ventures, we look at a whole bunch of things, and we want to be strategic investors, and we want to partner with companies that we invest in simply because we don't want to tell you what to do, but we want to help you with what you do and supplement in areas that you might need help with. So
absolutely.
Yeah. So thanks for that. So that was more of me saying thank you to Cathy, than asking a question, because I can, like I said, I have the privilege of calling Cathy whenever I need to ask her something, and I can do that. Thank you so much for your time, Cathy.
Absolutely. And thank you guys. I think you guys are doing great work. And of course, if any entrepreneurs are interested in our portfolio or the First Principles philosophy, definitely check us out, firstprinciples.vc. We've also been very transparent about our founder testimonials because, again, we try to hold ourselves to those standards, right? And that's something I've really learned from my partner, Nitin, is that you can only make a good name for yourself if you're actually providing value, and providing value is tiring and hard, but an entrepreneur's job is even harder. So as investors, we should work really hard to make sure we're actually bringing something to the table.
Thank you, Sita. Thank you, Cathy. And this is a wrap for Matchathon 2020. We always wanted to end it on a high, so it was a good thing, and we are very happy. And this is a good high for us, to have somebody like you. And, of course, we have Sita, from day one until now. She's just been there, taking, Innopark Ventures through. She puts the team together. I know it's been a pleasure working, with a great team. So we have two girls we've onboarded as a part of our team, Mihika and Amina, taken care of all the other things. So that is our team Innopark Ventures, and that's the team for Matchathon as well. So I would really say thank you to all of you for making this a wonderful event for us.
Thanks for all your support, Cathy, throughout all of it. Anytime or otherwise. Thanks.
Anytime. You're one of my relationships.
One of four there.
Long term. Yeah, one of very few.
Thank you so much.
Okay. Bye, you guys. Take care.
Thanks, Sita. Bye-bye. Thank you, everyone, for joining.
Bye. Thank you.
Bye-bye.